Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from the Journal, founder raps Lululemon on quality issues. Chip Wilson founded Lululemon. He built it into a yoga wear empire. Then he left the board in 2015. He watched from the sidelines as the company he built got bigger. He watched from the sidelines as the company he built got worse. Now he's calling the current board a new low for Lululemon. He's launching a proxy fight to replace board members. He's publicly shaming the company on LinkedIn. He's fighting for control because the company has lost its way, and he's the only person who seems willing to say it out loud. This is a story about what happens when founders step away from the companies they built. It's about what happens when profit maximization overtakes product quality. It's about how the people closest to the original vision are often the only ones who notice when that vision has been abandoned. Here's the situation. Lululemon had a quality problem, not a new problem, a repeated problem. Years ago, back in 2013, the company had issues with the sheerness and pilling of its pants. The pants were falling apart. They were see-through. The company's products weren't matching the premium positioning. Back then, Chip Wilson was still on the board. And his response was remarkable. He suggested in a TV interview that the problem was the customers, not the pants, the customers. Quote, "Quite frankly, some women's bodies just don't work for it." That's a statement that tells you something about how the company was thinking about product quality. The problem wasn't the product. The problem was the consumer. The company was blaming the user instead of the product. Wilson later apologized. He stepped down as chairman in 2013. He left the board entirely in 2015. He was gone. He had built the company, but he was no longer involved in running it. Presumably, the company moved on. Presumably, the quality issues got fixed. Then, this week, another sheerness problem emerges. The Get Low leggings. Same issue. Too sheer. Customers complained. The company paused online sales to review feedback. The company pulled the product off the website. Same problem. 13 years later. Same exact issue. And Chip Wilson exploded. He wrote on LinkedIn, "This is a new low for Lululemon." He's saying this isn't about employees. The employees are working hard. This is about the board. This is about the leadership. This is about the fact that the company has lost control of its core product quality. Now, here's where this gets interesting. Wilson didn't just complain. He took action. In December, he launched a proxy fight. He's going to nominate board members. He's going to try to replace the current board. He's the company's largest individual shareholder. He has skin in the game, and he's using that leverage to force change. The current CEO stepped down earlier this month. The company is looking for a new CEO, and Chip Wilson is saying, "I'm not going to sit on the sidelines anymore. I'm going to fight for control, because nobody else is protecting what I built." Let me think about what this reveals about the company's decision-making. When you have a quality problem, when you have a product that isn't living up to the brand promise, what do? You fix it. You investigate the root cause. You change the production process. You redesign the product if necessary. But what did Lululemon do? In 2013, they blamed the customer. They said the product was fine. The problem was the person wearing it. That's not a quality mindset. That's a blame-shifting mindset. That's a company that doesn't believe it has a problem. Then, 13 years later, the same problem appears again. The company pauses sales. The company says they're reviewing feedback. But the fact that the same problem appears suggests that nothing fundamental changed. Nothing was fixed. The company just moved on. This is a capital allocation problem. The company is allocating capital to growth. They're allocating capital to expansion. They're allocating capital to new store openings and new product lines. But they're not allocating capital to quality control. They're not allocating capital to getting the fundamentals right. Think about Lululemon's market position. It's a premium brand. It's positioned as technical apparel. It's positioned as high-quality yoga wear for affluent consumers. The brand positioning depends on quality. If the pants are see-through, the brand is broken. If the pants fall apart, the brand is broken. But if the company is maximizing current period earnings, if the company is optimizing for near-term revenue growth, then spending money on quality control becomes a cost center instead of a value creation center. It becomes something to be minimized. Chip Wilson understands this. That's why he's so angry. That's why he's willing to publicly fight the board, because he understands that you can't have a premium brand without premium quality. You can't premium pricing without premium execution. Now, let's think about the incentive structure. Wilson is the largest individual shareholder. He has capital at risk. He has reputation at risk. If Lululemon fails, he loses money. If Lululemon loses brand positioning, he loses money. If Lululemon becomes just another athletic apparel brand, he loses money. But the board members? They have compensation, they have options. They have governance fees. If the company maintains current earnings, the board gets paid. The board doesn't have the same downside as Wilson. They don't have the same long-term perspective. The CEO that just left? They were optimizing for near-term results. They were optimizing for revenue growth and margin expansion. They weren't optimizing for brand quality and long-term positioning. That's because the incentive structure was short-term. Here's what I find remarkable about this situation. This is a founder who built a company, who stepped away, who watched the company get bigger but worse, who watched the company lose its way, and the only way to fight back is to launch a proxy fight, to publicly shame the board, to mobilize his shareholding to force change. That shouldn't be necessary. The company should have internal mechanisms to catch quality problems before they become a pattern. The company should have people inside who notice when the product is degrading. The company should have decision-making processes that prioritize brand integrity over quarterly earnings. But those mechanisms don't exist. Or if they do, they're not working. Because the same problem appears twice, 13 years apart. Let me extract the lessons because there's something important here about how companies deteriorate. First lesson. Founder incentives are different from professional manager incentives. Chip Wilson built Lululemon. He bet his capital and his reputation on it. When he sees quality problems, he's personally upset, personally threatened, personally motivated to fix it. Professional managers are paid to deliver quarterly results. If the quarterly results are good, the manager is successful. The manager doesn't have the same long-term perspective as the founder. Second lesson, premium brands depend on quality, not on marketing, not on distribution, not on store count, on quality. The moment you cut corners on quality, the moment you stop prioritizing product excellence, the brand starts to erode. Customers notice, they talk. They go elsewhere. Lululemon built its brand by being obsessive about quality. Now it's being careless about quality. The brand erosion will follow. Third lesson. Board independence can mean indifference. The board is independent from the founder. The board is professional. The board has expertise. But the board doesn't have the founder's passion. The board doesn't have the founder's stake in the long-term success of the company. So the board defaults to optimizing for what it can measure. Revenue, margin, earnings, per share. All things that go up if you cut quality and spend less on product excellence. Here's what I think is happening at Lululemon. The company is being managed for current results. The company is optimizing for quarterly earnings. The company is trying to grow faster. And in the process, the company is sacrificing the fundamentals that made it valuable in the first place. The board doesn't see it that way. The board sees a company that's growing, that's profitable, that's hitting targets. The board sees a company that's successful. But Chip Wilson sees something different. He sees a company that's losing its way. He sees a company that's sacrificing brand integrity for short-term earnings. He sees a company that's repeating the same quality mistakes it made 13 years ago. One of them is wrong. And the interesting question is, which one? I think Chip Wilson is right. Not because he's always right. He's not. Back in 2013, he blamed customers for the sheerness problem. That was wrong. But he's right that quality problems are a signal. They're a signal that the company has lost focus on what matters. They're a signal that the decision-making process has broken down. When the same product quality problem appears twice, 13 years apart, that's not bad luck. That's not bad timing. That's a company that has fundamentally changed its priorities. A company that once was obsessive about quality is now indifferent about it. And the founder is the only one willing to say it out loud. That's remarkable. That's also sad. It's sad that the founder has to launch a proxy fight to get the board to care about quality. It's sad that the founder has to publicly shame the board on LinkedIn to get their attention. It's sad that the people running the company don't have the same passion for the product that the founder does. But that's what happens when founders step away. That's what happens when you replace founder-driven decision-making with professional management. You get competent managers. You get people who optimize for measurable metrics. But you lose something else. You lose the obsession. You lose the passion. You lose the conviction that product quality matters more than quarterly earnings. Chip Wilson is fighting to get that back. He's fighting to remind the board that they're not running a generic apparel company. They're running a premium brand. And premium brands are only premium if the product is premium. Here's what I'll leave you with. Watch what happens next. Watch whether the board takes Wilson seriously. Watch whether they fundamentally change the company's approach to quality. Or watch whether they keep going down the path they're on. Bigger stores, more products, more earnings, until the brand is completely destroyed. If Wilson wins the proxy fight, if he gets to reshape the board, then maybe Lululemon can remember what made it valuable in the first place. If he loses, then Lululemon is going to keep deteriorating. The company will keep growing. The company will keep becoming less special, until one day it's just another athletic wear brand competing on price. That shouldn't be acceptable. Not to investors who bought the premium brand, not to customers who paid premium prices, and not to the founder who bet everything to build it. Rolling to next article, Shale boss joins fight at Coterra. Scott Sheffield planned to spend his retirement in sunny Santa Fe, New Mexico, focused on charity work. He was 73 years old. He had sold Pioneer Natural Resources to Exxon in a $60 billion blockbuster deal. He had built an empire. He had cashed out. He was done. Then came the revenge. The Federal Trade Commission had barred him from the Exxon board as a condition of approving the merger. They accused him of attempted collusion with OPEC to raise oil prices. He sued. The allegations threatened to tarnish his reputation. He was isolated within the industry. He told a reporter dryly, "I don't talk to other shale execs anymore, but last summer, the FTC's new Republican majority nixed the ban. They let him rejoin Exxon's board." It was, in his words, a legacy-saving move. Except, Sheffield had already decided. He didn't want the board seat anymore. He accused Exxon of breaking the commitment it made to him. He walked away angry. And now, 3 weeks ago, an activist investor called. They asked if he would join their fight. They didn't expect him to say yes. The fight would require massive amounts of time and energy. He's a retired billionaire. Why would he do it? But Sheffield said yes. And that decision tells you everything about what happens when capital allocation fails. When a merger that looked good on paper turns out to be a disaster. When the people closest to the industry see the failure before anyone else. Here's the situation. In 2021, 2 oil and gas producers merged. Cabot Oil and Gas, a natural gas producer in the Northeast, and Cimarex Energy, an oil operator in Texas, Oklahoma, and New Mexico. It was a $14 billion deal. They created Coterra Energy. The logic made sense, at least on the surface. Diversification, multiple basins, oil and gas exposure, spread the risk, get bigger, achieve scale. It was a disaster. Coterra now trades at a significant discount to both Permian-focused peers and gas-focused peers. That's what the market is saying. That's the verdict. The market rejects this merger. The market says it was a failure. The company prioritized self-preservation over strategic merit. Tom Jordan was the CEO of Cimarex. He became the CEO of the combined company. He's been running Coterra since the merger. And on an earnings call this week, he said the activist letter contained some factual errors. He said he was disappointed that Kimmeridge released the letter without reaching out first. But he was open to suggestions. That response is telling. He's defending the merger. He's saying there were errors in the critique, but he's also admitting he's open to change, which means he knows something is wrong. He just doesn't want to admit it publicly. Now let's think about the decision-making that led to this merger. Scott Sheffield, as CEO of Pioneer, actually considered buying Cabot Oil and Gas back in 2021. He gathered his team. They discussed it. The team pushed back. They said no. And Sheffield, credibly, abandoned the idea. That decision was probably correct. That decision probably saved Pioneer from the mistake that Cimarex was about to make. What was the logic of the Cabot-Cimarex merger? What made Tom Jordan think this was the right move? The two companies controlled assets in different regions, different commodities, different geological basins. The theory was that this diversity would be valuable. The theory was that combining them would create a more resilient business. But the market disagrees. The market says the merger was a mistake. The market says you should either focus on the Permian, where the best returns are, or focus on natural gas, where you have exposure to that commodity. But trying to do both, trying to be a diversified energy producer, is not creating value. This is classic capital allocation failure. The merger looked reasonable in the abstract, but it was a strategic error. It tried to do too many things at once. It diluted focus. It created management complexity. It forced the company to compete in multiple basins where specialized competitors had advantages. Now Kimmeridge, an activist investor, is saying the company needs to change. They need to refocus. They need to sell the natural gas operations and concentrate on the Permian. That probably makes sense. That's probably the right capital allocation move. And Scott Sheffield is going to fight for that change. He's been enlisted as a board nominee. He's going to be the face of the activist push, which is remarkable because Sheffield has a credible voice. He built Pioneer. He dominated the Permian. He was Shale's de facto leader for years. He sold Pioneer to Exxon. He knows what works. Now here's the interesting question. Why did Sheffield agree to this fight? He's already rich. He's already retired. He's already been damaged by the FTC accusations. Why risk his reputation again? Why spend the time and energy? I think it's because he understands something fundamental. The merger at Coterra was wrong. He considered it himself and rejected it. He knows why it was wrong. He knows that the market is right to reject it. And he knows that the only way to fix it is to have someone with credibility make the case internally. Kimmeridge owns a little over 1% of Coterra. They have leverage, but they're not the biggest shareholder. They need someone with industry credibility to validate their critique. They need someone who can say, I built a company in this space. I know what works. And this merger is a mistake. Sheffield provides that credibility. More importantly, Sheffield has nothing to lose. He's already been isolated by the industry. The FTC already accused him of collusion. Exxon already rejected him. So taking on Jordan and the Coterra board is not a big risk. It's actually an opportunity. It's a chance to rehabilitate his image. It's a chance to show that he still has the judgment and the conviction to call out bad capital allocation. Let me think about the merger from first principles. Why would Jordan think this was the right move? Probably because he believed in scale. More assets, more production, more revenue. He probably believed in portfolio theory, diversification, risk management. Spread your exposure across multiple basins and multiple commodities. But that theory has been proven wrong. The Permian is where the returns are. The Permian is where the economics are best. Focusing on the Permian is the right capital allocation move. Trying to be everything to everyone, trying to have significant exposure to natural gas in the Northeast while also competing in the Permian is not the right move. This is a pattern we see repeatedly in M&A. Companies merge because they think diversification is valuable. They think consolidation creates synergies. They think bigger is better. But then the market prices the combined company at a discount. The market is saying, you messed this up. You destroyed value. Now Sheffield is going to fight to undo that mistake. He's going to nominate board members. He's going to push for a spin-off or a sale of the natural gas business. He's going to push for refocus on the Permian. He's going to push for better capital allocation. Will it work? That depends on Coterra's shareholders. It depends on whether they're willing to vote out the current board. It depends on whether they agree with Sheffield that the merger was a mistake. But here's what matters. Sheffield is making this fight. He's risking his time and his reputation. He's taking on a former competitor. He's saying, I know what works in this industry. And Coterra is not doing it. That's the voice of someone with experience. That's the voice of someone who has made capital allocation decisions before. That's the voice of someone who has succeeded and failed and learned from both. Let me extract the lessons because there's something important here about governance and capital allocation. First lesson, scale is not strategy. Merging two companies because they're in adjacent spaces, because they can achieve scale, is not the same as having a coherent strategy. Sheffield understood this when he rejected the Cabot deal. Jordan did not. Jordan thought bigger was better. Jordan thought diversification across basins was valuable. He was wrong. The market has proven him wrong. Scale without strategy is just a bigger company making bigger mistakes. Second lesson, founder judgment is different from professional manager judgment. Sheffield built Pioneer by making clear strategic choices. Focus on the Permian. Dominate that region. Excel at what you do. Jordan tried to do something different. He tried to build a diversified energy company. He failed. The founder's instinct, focus, excellence, domination, was right. The professional manager's instinct, scale, diversification, portfolio theory, was wrong. Third lesson. Activist investors are often right about capital allocation. Kimmeridge is not saying anything revolutionary. They're saying Coterra should focus on the Permian. They're saying the natural gas business is underperforming. They're saying the merger was a mistake. These are straightforward capital allocation arguments. And the market agrees. Coterra trades at a discount. The activism is probably correct. Here's what I find remarkable about Sheffield's decision. He's 73 years old. He's been damaged by a government agency. He's been isolated in the industry. He has every reason to stay retired and stay quiet. But instead, he's coming back. He's fighting. He's putting his reputation on the line again. That's not a financial decision. You don't come back from retirement at 73 for financial reasons when you're already a billionaire. You come back because you have conviction. You come back because you know something is wrong. You come back because you want to fix it. Sheffield knows that Coterra is making a capital allocation mistake. He knows it because he faced the same decision and rejected it. He knows it because he built a company that succeeded by doing the opposite. He knows it because the market is telling him he's right. So he's fighting. He's nominating board members. He's pushing for change. He's using his credibility and his experience to make the case that the company needs to refocus. If he succeeds, if the activist campaign wins board seats, if Coterra sells the natural gas business and focuses on the Permian, then the company's shareholder value probably increases. The company becomes more focused. The capital allocation becomes more disciplined. The market probably revalues it upward. If he fails, if the board manages to defeat the activist challenge, then Coterra probably continues to underperform. The company continues to trade at a discount. Eventually, the underperformance catches up with the board. Eventually, there's a change. But Sheffield is betting that the market is already right. The market is already saying the merger was a mistake. The market is already pricing it in. So the change is probably inevitable. The only question is when. Here's what I'll leave you with. Scott Sheffield faced a choice. He could have stayed retired in Santa Fe, secure in the knowledge that he had built a great company and sold it successfully. Or he could have come back, risked his time and energy, and fought for what he believed in. He chose to come back. He chose to fight. That decision tells you something important about what it takes to be a great allocator. It takes conviction. It takes experience. It takes willingness to say what you believe is true, even when it's unpopular, even when it might damage you, even when it might fail. Sheffield has all of those things, and he's using them to fight for better capital allocation at Coterra. That fight is probably going to win. The market has already said the merger was a mistake. Sheffield is just making it official. Rolling to next title, Autodesk Restructuring set to eliminate 1,000 positions. Autodesk is cutting 1,000 jobs. That's roughly 7% of its workforce. The market responded by pushing the stock up 4.8% to $269.77. That's remarkable. That's unusual. When a company announces layoffs, the stock typically goes down. Investors typically see it as a sign of weakness. A sign that the company is struggling. A sign that management has lost control of costs. But Autodesk went up, which tells you something important about what the market believes is actually happening here. The market believes this restructuring is not a sign of weakness. It's a sign of strength. It's a sign of discipline. It's a sign that management is willing to make hard capital allocation decisions. Here's the situation. Autodesk makes AutoCAD and other digital design software. It's a massive business. But the company has decided that it needs to become more efficient. It needs to reallocate resources. It needs to strengthen sales and marketing. So it's cutting 1,000 jobs. And a significant portion of those cuts will be within customer-facing sales functions. That's the key detail. They're cutting sales jobs, not back office, not support, not administrative overhead. Sales jobs, the revenue-generating part of the organization. Why would you cut sales jobs if you want to grow? Why would you cut the people responsible for bringing in revenue if you're trying to strengthen sales and marketing? The answer is because you're restructuring how sales works. You're not eliminating sales. You're changing how sales operates. You're streamlining customer engagement. You're bolstering your sales channels. You're making your sales organization more efficient and more strategic. The company forecasts the move will result in pre-tax restructuring charges of roughly $135 to $160 million. Most of that is employee termination benefits. That cash is going to go out the door in fiscal year 2027. The company expects to record about $90 to $110 million in charges in the fourth quarter of fiscal 26, and the remainder the following year. That's real money. That's capital being deployed to restructure the organization. That's an investment in being more efficient in the future. Now let's think about what this decision reveals about Autodesk's capital allocation philosophy. The company is not trying to maximize current quarter earnings. If they were, they would spread out the restructuring charges. They would minimize the pain in any given quarter. They would try to protect near-term earnings. Instead, they're front-loading the charges. They're taking a hit now. They're taking it cleanly. They're absorbing it in the fiscal year when they can. And they're doing it because they believe it's the right long-term move. That suggests management has conviction. They have a plan. They're not just cutting costs because they have to. They're restructuring because they believe it will make the company more competitive over time. Let me think about what happens next. The company is going to be smaller. It's going to have fewer people. It's going to have less headcount. But it's going to have a more efficient sales organization. It's going to have better customer engagement. It's going to have stronger sales channels. In theory, that means higher quality revenue, better customer relationships, more efficient customer acquisition, higher lifetime value per customer. The question is, can management execute on that vision? Can they actually become more efficient and more strategic with a smaller sales organization? Or are they just cutting headcount and hoping for the best? That's the execution risk. That's the part where things can go wrong, because cutting salespeople is easy. Building a more efficient sales organization is hard. It requires discipline. It requires focus. It requires management clarity about what the new sales organization should look like. Now let's look at the broader context. Autodesk is operating in a competitive software market. It has competitors. It has market pressures. It has to keep customers happy while also managing costs and maintaining margins. The restructuring is being positioned as the final phase of a longer effort to streamline customer engagement. This isn't a one-time cut. This is part of a continuous process of making the organization more efficient. That's actually a good sign. That suggests management is thinking about efficiency systematically, not just reacting to a crisis. The company also said the plan reallocates resources in certain other functions to accelerate strategic priorities. That's vague, but it suggests there are parts of the organization getting funded. Parts getting cut, parts being reinvested. That's what real capital allocation looks like. Here's what I find interesting about this decision. Autodesk is willing to cut revenue-generating capacity in the near term to build something better in the long term. That takes confidence. That takes conviction. That takes a management team that believes in the long-term strategy and is willing to endure short-term pain. The stock going up suggests the market agrees. The market believes management knows what they're doing. The market believes this restructuring will result in a stronger, more efficient company over time. But there's also execution risk. There's the risk that the new sales organization doesn't work. There's the risk that the company loses customers during the transition. There's the risk that the efficiency gains don't materialize. There's the risk that competitors take advantage of the disruption. All of those are real risks, and they're all embedded in this restructuring decision. Let me extract the lessons because there's something important here about how companies make capital allocation decisions under pressure. First lesson, sometimes you have to cut to grow. The intuition is to protect revenue, to keep the salespeople, to keep the customer-facing organization intact. But sometimes the right move is to restructure, to make the sales organization more efficient, to reallocate resources from breadth to depth, from volume to quality. That takes discipline and conviction. And it takes a market that trusts your judgment enough to buy the stock when you announce it. Second lesson, restructuring is an investment, not just a cost-cutting exercise. Autodesk is spending $135 to $160 million to restructure. That's capital. That's an investment in a new operating model. That's real money with no guarantee of return. But management believes the returns will be there. They believe the more efficient sales organization will generate more revenue and more profit over time. That's the bet. Third lesson, execution risk is real. Cutting jobs is the easy part. The hard part is building something better. The hard part is making sure the new sales organization actually works. The hard part is retaining customers and relationships through the transition. That's where companies often fail, not because the strategy is wrong, but because the execution falls short. Here's what I think is happening at Autodesk. The company realized its sales organization was bloated. Not enough focus, too much breadth, too many touch points, too many overlapping channels. They've decided to restructure. They've decided to become more efficient. They've decided to invest in building a better sales organization. It's a bold move. It's a bet on management's ability to execute. And the market is rewarding it. But that reward is provisional. The stock is up because the market believes in the strategy. If the strategy fails, if the execution falls short, if the new sales organization doesn't work, then the stock will come down. And the company will have wasted $135 million and lost 1,000 employees. That's the asymmetry of capital allocation. The upside is significant. The downside is also significant. And it all depends on execution. Here's what I'll leave you with. Autodesk is making a bet. They're betting that they can cut their sales organization by a meaningful amount and still be more effective in the market. They're betting that efficiency and focus are more valuable than breadth. They're betting that quality revenue is better than volume revenue. The market believes them, but that belief is conditional on execution. If they execute well, if the new sales organization works, if customers stay and the business grows, then this will be seen as a brilliant capital allocation decision. If they fail, if customers leave, if the business stalls, then this will be seen as a mistake. That's the reality of restructuring. That's the reality of capital allocation under uncertainty. The stock going up suggests the market thinks Autodesk will execute. Time will tell if that belief is justified. Moving to next title, BitGo shares make their debut on NYSE in a test of digital asset company IPOs. BitGo's IPO raised about $212.8 million at $18 a share, and the stock closed its first day at $18.40, valuing the company at roughly $2.1 billion. This is the first serious public market stress test for a crypto infrastructure business since the sector's downturn. In one trading session, you can see the question forming: is this a durable cash flow machine sitting on the plumbing of digital assets, or just another way to ride the next cycle up and down? The article is from the Wall Street Journal, and it's describing more than just a listing. It's showing us how capital, founders, regulators, and retail investors are now negotiating with each other around crypto's core infrastructure. This isn't a meme coin. This is custody, trading, staking, subscriptions, the boring but essential rails that everything else runs on. When a company like that comes public, the market is effectively voting on whether the system around it is investable over a decade, not just over a quarter. Let me start with the central figure. Mike Belshie founded BitGo in 2013. He is a Silicon Valley entrepreneur who helped pioneer the multi-signature wallet, the digital equivalent of a joint bank account, where moving funds requires multiple keys. That's an operator choice. He went after the safest, lowest margin part of the crypto stack first: custody. Not the shiny front-end exchange, not the leveraged casino, but the vault. Over more than a decade, BitGo expanded from custody into prime brokerage and institutional trading. It became one of the quiet backbones of the digital asset ecosystem. Large clients, large balances, low drama. That's important because it tells you how Belshie thinks as a builder. He built around risk management and infrastructure, not around speculation. He positioned BitGo as the firm that survives other people's blow-ups. Now he's taking it public. And here's the key line in the prospectus. Once the offering is done, Belshie will control more than 50% of the company's total voting power. That means founder control. One person, majority vote. As investors, we need to interpret that correctly. Founder control can be a moat or a muzzle. It can mean long-term, compounding judgment without quarterly noise. It can also mean no external brakes if discipline slips. Look at what he's built in numbers. BitGo earned $156.6 million in 2024 and $35.3 million in the first 9 months of 2025. It generated $4.19 billion of revenue in the first 6 months of 2025, up from $1.12 billion a year earlier. That is a near fourfold increase in top line in 12 months. These are not small numbers. This is not an experiment. This is a scaled, cash-generating, systemically important piece of the crypto market. But the composition of those revenues matters. Historically, BitGo lived in the low-margin custody segment. Safe, sticky, boring. Today, the more lucrative streams, trading, staking, subscriptions, drive much more of the upside, and the company itself admits those are highly sensitive to the volatility of digital assets. That is the core tension in the story. The revenue that makes the IPO look exciting is the same revenue that is most exposed when the cycle turns down. Let's talk about the inflection point. Why now? Why bring a custody-first business public after a crypto downturn? Why not wait for the next hype wave? You can see the answer in the ecosystem. We've just had successful listings from Circle Internet Group and Bullish. BitGo is following them onto the New York Stock Exchange, not in 2017 frenzy mode, but in a market where Bitcoin is trading around 80 to 9,000, about 29% below its peak above 126,000 last year. Prices are down from the high, but not dead. Volumes have come back enough to make the income statement look strong again. On the regulatory side, BitGo has just received conditional approval from the Office of the Comptroller of the Currency to convert into a bank. It is also custodian for the reserves backing USD1, the stablecoin launched by Trump's flagship crypto venture, World Liberty Financial. That combination, bank license path plus role in a politically visible stablecoin, changes the strategic calculus. BitGo is not just any startup. It's one of the few bridges between regulated dollars and on-chain tokens. For Belshi as an allocator, this is the window. He's been private for over a decade. The company is profitable. It's growing fast. Its brand is relatively clean compared with some peers. And the public market appetite for crypto-adjacent names has reopened just enough to accept an IPO, but not so much that the deal becomes a speculative mania. That's exactly when a rational founder sells a slice of his equity to the public and locks in permanent capital. The capital allocation decision is simple at the surface. Raise roughly $212.8 million by selling about 11.8 million shares at $18. But inside that are a series of trade-offs. The company and existing shareholders get cash. The public gets access to a unique asset. Belshi keeps control. The opportunity cost for him is real. Staying private would have preserved optionality. No quarterly disclosure, no public market sentiment swings, no day one mark-to-market. But it would also have limited the balance sheet at precisely the moment when infrastructure players need scale to compete. On custody, on trading spreads, on technology, on regulatory capital. The trade-off for public investors is that they are buying into a founder-controlled, cycle-sensitive business at the very moment the industry is trying to re-legitimize itself. You get exposure to the pipes rather than the coins, which is safer than buying the token directly. But your outcomes are still tethered to the same underlying forces: token prices, regulation, and trust. Look at how the IPO actually traded. Priced at 18, opened at 22.43, closed at 18.49. That's a round-trip narrative in 6 hours. Fast money tried to push it, found no retail frenzy strong enough to sustain a big day. One pop, and we ended just above the offer. The valuation settled around $2.1 billion. That lack of explosive upside is telling. Warmer than cold, cooler than hot. Tom Bruni put it well. People deep in the weeds of the traditional finance meets crypto convergence are excited. Otherwise, it's flying a bit under the radar. That's not a bug for a long-term investor. That's actually what you want. You want a business with real earnings, real scale, low retail froth at the start. But there's another layer. BitGo and its peers are explicitly targeting retail in their IPO allocation. Bullish, Gemini, and others have reserved larger chunks of their offerings for individual investors. Robinhood is telling traders they can request shares in IPOs like BitGo. Demand for IPO access has multiplied over the past year. Moomoo, another platform, got just under 10% of the share allocation from BitGo. Think through the incentive here. Crypto infrastructure companies know that their core users are not pension funds. They are individuals, traders, retail, so they weaponize their own community as a distribution channel for their equity. That deepens loyalty, but also increases the risk that your shareholder base is dominated by short-term sentiment. When Bitcoin drops 20% in a week, those holders are more likely to hit the sell button, regardless of BitGo's fundamentals. Now, layer in regulation. BitGo is profitable. It's growing. It has a path to a bank charter. At the same time, the U.S. regulatory regime for digital assets remains unresolved. A critical Senate Banking Committee vote on the Clarity Act was just postponed after Coinbase withdrew its support. Traditional banks argue that stablecoin rewards and yield-bearing token products look like unregulated deposits that threaten savings accounts. BitGo sits right in the middle of that fight. It safeguards reserves for USD1. It lives at the interface between token yields and fiat regulation. If regulators swing hard, those lucrative new revenue streams, trading, staking, subscription economics, can get squeezed. If regulation clarifies and legitimizes these products, BitGo's positioning could compound for a decade. So you have three axes of risk and reward: price volatility of the underlying assets, regulatory trajectory on stablecoins and yield, behavior of a retail-heavy shareholder base. And over all of that, you have one person with more than 50% of the vote. For a value investor, the question becomes, do you trust the allocator? Not the market, not the cycle, the allocator. Belshi has already made one big structural bet. Build in the low-margin, high-trust part of the stack first, and add riskier, higher-margin services later. That is the opposite sequencing of many failed crypto companies that chased leverage and yield first and tried to retrofit risk management later. He's also chosen to come public modestly, a $2.1 billion valuation for a profitable, scaled infrastructure business with $4+ billion in half-year revenue. That's not cheap in absolute terms, but relative to the speculative excess we've seen in this space, it's not insane. It's calibrated. And yet, we cannot ignore the fragility. BitGo itself admits that its more lucrative revenue is highly sensitive to digital asset volatility. Bitcoin was around 89,000 on listing day, about 29% below last year's peak. If we go through another deep drawdown, these same revenue lines will compress. That will test both the business and the shareholder base. So what are the lessons? First, incentives shape the entire structure. Belshi's voting control means he can prioritize long-term infrastructure over short-term earnings. But retail allocations and IPO hype create pressure in the opposite direction. The business will be pulled between a founder with a decade-long view and a shareholder base with a one-week time horizon. As investors, we should always ask, whose timeline actually governs behavior in a downturn? Second, success plants the seeds of risk. Custody is boring until you're profitable, scaling, and publicly listed. Then the temptation is to lean into higher margin activities: trading, staking, subscription products tied to yield. Those are exactly the lines most exposed to regulatory action and price cycles. The parts of BitGo that justify a high multiple are also the parts most likely to shrink abruptly in a crisis. Third, infrastructure does not fully insulate you from the asset. People like to say, sell picks and shovels, not gold. But if everyone stops digging, the shovel business still suffers. BitGo is less fragile than a meme coin, but it is not independent of the asset class. Its revenues, its regulatory risk, its equity valuation, they all move with the tide of digital assets. So how do I answer the core question here? What does BitGo's IPO really tell us? It tells us that we've reached the stage where crypto's plumbing companies want permanent capital and public legitimacy. It tells us that at least one of them has the earnings, the growth, and the governance structure to ask for it, with a straight face. And it tells us that the market, cautiously, is willing to say yes, at least at $18 a share and a $2 billion valuation. The sentence I'd keep in my head for years is this: when the pipes of a speculative system come public, you are no longer betting on the next trade. You are betting on the judgment of the person who built the pipes. Now, towards last article, ship buyer targets shadow fleet. Anil Sharma, the founder and CEO of GMS, the world's largest cash buyer of ships for scrap, just filed a request with the Treasury Department to buy sanctioned vessels from Iran, Russia, and Venezuela. Let that sink in for a moment. He's not asking for permission to do something legal that's already being done. He's asking for permission to do something that currently cannot be done. He's asking for the government to change its rules so he can buy ships that are off-limits to American companies. And he's making the case that doing this would actually help the United States. This is a masterclass in capital allocation and regulatory positioning. This is an operator understanding where the market is moving and positioning himself to capture the surplus when the rules change. This is someone who knows that the most valuable businesses are often the ones that solve the government's problem before the government realizes it's willing to solve it. Here's the situation. There's a shadow fleet. The US, the European Union, and the UK have all stepped up their actions to identify and sanction the owners and operators of these ships. The U.S. even seized 7 tankers recently. But maritime intelligence firm Windward estimates there are more than 2,000 vessels engaged in dark fleet activities. The U.S. cannot seize all of them. The physical enforcement approach is hitting the limits of what's feasible. Clarkson's research says 936 tankers are under sanction today. That's more than double the number at the beginning of last year, the equivalent of 16% of global tanker fleet capacity. These ships are on average more than 21 years old, 7 years older than the average tanker on the ocean. They're floating rust buckets. They operate without insurance. They sail under false flags. They're an accident waiting to happen. And they're also a liability for the U.S. government. Every ship that's sanctioned is a ship that might be seized. Every seized ship requires enforcement resources. Every enforcement action is a reminder that the government cannot control the flow of illicit oil. Every visual image of a seized dark fleet vessel is a political win for the countries that are supposed to be sanctioned. Now Anil Sharma looks at this problem and sees an opportunity, not from the perspective of the dark fleet operators. From the perspective of the U.S. government. The government wants these ships off the water. The government wants to shrink the shadow fleet. The government wants to prevent Iranian, Russian, and Venezuelan oil from reaching markets. GMS can do that. GMS buys ships and transports them to specialist yards in Turkey, Bangladesh, Pakistan, and India where they're scrapped. The vessels are stripped of fixtures and fittings, and the steel is melted or reused. That's the business. That's what GMS does. Sharma's argument is straightforward. If the U.S. government allows him to buy sanctioned ships owners can dispose of them. They can exit the dark fleet business. They can avoid paying penalties or getting their ships seized. Sharma says he can take 100 or more dark fleet ships a year off the water. That would help the U.S. achieve its goals. It would reduce the size of the shadow fleet. It would make legitimate shipping safer by removing poorly maintained vessels from congested trade routes. And it would provide revenue for U.S. banks and related industries. That's the proposal. That's the capital allocation decision. Sharma is asking the government to grant him access to a market that currently does not exist, a market that is currently explicitly forbidden. And he's making the case that granting him access would benefit the U.S. Now let's think about what this reveals about Sharma as an allocator. First, he understands where the pain point is. The U.S. government is trying to enforce sanctions. But brute force seizure is expensive and limited. You can only seize so many ships. You can only deploy so many resources. But if you create a legal mechanism for sanctioned ship owners to exit, if you give them a legal option that doesn't involve seizure and penalties, then you've solved the problem more efficiently. And Sharma understands that solving the government's problem is the most valuable business you can be in. Second, he understands that trust is a scarce commodity. He says, with humility and modesty, that he is the only guy capable of doing this. Number 1, because of the scale GMS has. Number 2, because of the U.S. background. Number 3, because of the track record. Think about that claim. He's saying, I am the monopoly provider of trust for this service. No other ship scrapper has the U.S. connections. No other scrapper has the regulatory credibility. No other scrapper could be trusted to actually scrap dark fleet ships rather than help them continue operating. That's a powerful competitive position. Third, he understands the political window. The Trump administration is in power. The Trump administration just oversaw the deposing of Nicolás Maduro in Venezuela. The Trump administration is focused on energy security and sanctions enforcement. The Trump administration has shown a willingness to be unconventional in its approach to policy problems. This is not the moment to ask for a dark fleet license under a Biden administration. This is the moment to ask for it under Trump. Sharma is correct that the Trump administration has shown no desire to help dark fleet operators. But that doesn't mean they won't help an American company that can solve a sanctions enforcement problem. Claire O'Neill McCleskey, who until recently led OFAC's compliance division, said it was unlikely the Trump administration would authorize a mechanism that provides payments to sanctioned ship owners. She said they would need some other incentive on top of just getting the vessel off the water. But Sharma has already anticipated that. He suggested the U.S. could devise a scrapping system whereby shadow fleet operators pay a penalty to the U.S. government, and the government puts conditions on the use of funds from the sale. That's brilliant. That's taking the regulatory risk off the table. That's saying, don't give them money, make them pay. Make the penalty so large that scrapping becomes economically rational relative to keeping ships idle or selling them to other shadow fleet operators. And Sharma says his suggestions have been well received by OFAC officials. A Treasury Department representative didn't comment on the license application directly, but said, "To safeguard maritime safety, we are committed to responsible solutions to get these designated vessels off the water." That's not a rejection. That's not even neutral. That's a signal that the government is open to the idea. That's the sound of a capital allocation door opening. Now let's think about the risks and the opportunity cost. What was expected? Sharma would file for a license, and it would be processed like other regulatory applications. The government would weigh the pros and cons and either grant it or deny it. What actually happened? The government indicated openness to the concept. OFAC officials said his suggestions were well received. A Treasury representative acknowledged the policy goal of getting shadow fleet vessels off the water. The opportunity cost for Sharma? He has to wait. He has to endure regulatory uncertainty. He has to maintain his credibility in a business where trustworthiness is paramount. If this deal falls apart, if the Trump administration decides not to grant the license, then Sharma has spent political capital and management time on something that didn't happen. He signaled to competitors that there's a market opportunity that might be captured. But the upside? If OFAC grants the license, if a regulatory mechanism is created, if sanctioned shipowners start bringing dark fleet vessels to GMS for scrapping, then Sharma has created a multi-billion-dollar revenue stream. He has converted a government policy problem into a private company profit center. He has leveraged his existing scale and credibility to capture a market that didn't previously exist. That's the asymmetry of capital allocation decisions. The potential upside is enormous. The downside is mostly sunk time and management attention. Let me extract the lessons, because there's something fundamental here about how operators create value. First lesson: the most valuable businesses often solve government problems, not in a mercenary or exploitative way, but in a way where the government's interest and the private company's interest are aligned. Sharma is not asking for a bailout. He's not asking for subsidies. He's asking for permission to buy something and process it profitably. The government gets its problem solved. GMS gets a business. It's a positive-sum game. Second lesson: trust can become a moat. Sharma claims only he can do this because only he has the scale, the U.S., background, and the track record. Those are three things that can't be easily replicated by competitors. A smaller ship scrapper might have the technical capability to scrap dark fleet vessels, but they don't have the government credibility. They don't have the regulatory relationships. They don't have the trust. Sharma has spent decades building those things, and they're now worth billions. Third lesson: regulatory risk is real and timing matters. The Trump administration could change its mind. A new administration could reverse the policy. Congress could pass legislation that closes the loophole. Sanctions could be lifted, eliminating the entire dark fleet problem. Sharma is betting that none of that happens. He's betting that the policy window stays open long enough for the business to be built and for cash flows to compound. Here's what I find remarkable about Sharma's move. He's not a lobbyist. He's not a consultant. He's not someone who makes money by advising governments. He's a businessman. He's an operator. He sees a market problem, and he's positioning himself to solve it in a way that aligns with government policy objectives. That's the opposite of most relationships between business and government, where the company is trying to extract value from the government and the government is trying to regulate the company. Here, Sharma is saying, "Let me help you solve your problem. Let me bear the operational risk and the capital risk. All I want is the right to buy these ships and process them." The government's response has been surprisingly positive. Not a full yes, but not a no either. A signal of openness, an acknowledgement that the problem exists and that Sharma's solution might be worth considering. That signal is worth enormous capital, because Sharma can now go to investors and say, "We have a government policy tailwind. We have a regulatory pathway that's being discussed at the highest levels. We have a market opportunity that doesn't exist anywhere else in the world." This is not speculative. This is backed by OFAC officials saying they're open to it. Here's what I'll leave you with. Capital allocation at its best is about seeing where the system has a pain point and positioning yourself to solve it profitably. Sharma sees that the U.S. government is trying to enforce sanctions on dark fleet vessels, but is limited by enforcement resources. He sees that sanctioned shipowners are stuck with ships they can't sell and can't operate. He sees that the global maritime system has a safety problem because of poorly maintained dark fleet vessels, and he sees that GMS can solve all three of those problems at once. In return, GMS gets to buy and scrap thousands of ships. In return, Sharma gets to convert a regulatory prohibition into a profitable business line. That's the kind of capital allocation that compounds. That's the kind of operator move that should be studied for decades to come. The question is not whether the license will be granted. The question is whether Sharma's positioning is correct about what solves the government's real problem. Not seizure and penalties, but exit and scrapping. If he's right about that, then the deal will happen. And GMS will have expanded from being the world's largest ship scrapper into being the world's most important sanctions compliance mechanism. This is Avi. Like and subscribe. On to the next.